So today we're going to talk about the Federal Reserve, the central bank of the United States, and this is sponsored by AEDU. The reason why I wanted to make this presentation is simply because the Federal Reserve plays a major part in economic stability in the United States. And as students studying the field of economics, it's important to know about this institution, what it can do, as it plays a major role in economics in the United States of America. So first, I'd like to talk about the background. So the legislation that basically created the Federal Reserve was passed on December 23rd, 1913. And the executive branch of the Federal Reserve, in essence, the executive branch, is the Board of Governors. So the Board of Governors are chosen by the President and confirmed by the Senate, and they have 14-year terms. And the chairman of the Fed, he or she is basically so imagine the President of the United States. He is the leader of the country. Think of the chairman of the Fed as the same way. The chairman or chairwoman of the Fed is the leader of the Federal Reserve, and they have 4-year terms. And we'll talk about the previous chairman and current chairman later in this presentation. So the current system is based off a 1935 law and is reinforced by the Glass-Steagall Act and the Banking Act of 1935, as well as a recent act, the Dodd-Frank Law in 2010. This basically revised some of the old policies, made it more efficient, and basically streamlined some of the operations. So, as I promised, we'll be talking about the chairman as well as the chairwoman. So, I'm going to talk about 5 of these leaders, and these were the most significant in essence. So, the 5 chairmen, one of them being chairwoman, are Mariner Stoddard Eccles, Paul Volcker, Alan Greenspan, Benjamin Bernanke, and Janet Yellen. Eccles was chairman notably during President Truman's administration, but he was also chairman during Roosevelt's administration. Paul Volcker, he was chairman during President Carter's administration. He was just appointed then. He was also chairman during part of Reagan's administration, where he combated the recession. Alan Greenspan was chairman during President Reagan's administration, but he also creeped into some other presidencies. Benjamin Bernanke was notably chairman during President George W. Bush's administration, and Janet Yellen is most notably chairman during President Obama's administration. So now let's talk more in depth about these chairmen. I just want to give them some background so you can see the skills that they have attained, and it establishes more credibility for these entities. So Chairman Eccles, he was chairman between 1934 to 1948. So a little bit about himself. He created Eccles Browning affiliated banks. This is basically a conglomerate of his father's holdings. He became a millionaire by the age of 22, and he was involved in the creation of the Emergency Banking Act and the Federal Deposit Insurance Act. Because of these 2 acts, if a banking run would ever occur, the people will not suffer as much as they suffered in the Great Depression. They would still have some insurance. They have something to fall back on, and they'll have some of their money while the federal government and the Federal Reserve try to fix that economic scenario. So Paul Volcker, Chairman Volcker, he was chairman between 1979 to 1987. His nickname was Tall Paul. He got his MA in political economy from Harvard University's Graduate School of Arts and Sciences and Public Administration. He was also a financial economist with the Chase Economics Bank, and most notably, he was the president of the Federal Reserve Bank of New York. Chairman Greenspan. He was chairman between 1987 and 2006. His nickname was Big Al. He got his PhD in economics from New York University. He was also a think tank director. He was a chairman for the President's Council of Economic Advisors, and he was part of the board of directors for many companies. And I just wanted to elaborate for the President's Council of Economic Advisors. This was during President Ford's administration. So now let's talk about Chairman Bernanke. He was chairman between 2006 and 2014. His nickname was Helicopter Ben. A previous occupation of his was a waiter south of the border. He got his PhD in economics from Massachusetts Institute of Technology. He was a professor at Stanford, New York University, and Princeton. and he was appointed to the Board of Governors of the Federal Reserve in 2002. And now let's talk about our current chairman, or chairwoman. She was appointed to be the chairman of the Fed, or chairwoman based on how you look at it, in 2014, and she will serve the remaining of her term, and if she's re-elected, she'll keep going. She got her PhD in economics from Yale University. One thing I like to point out is that in her class for economics to get that PhD, she was the only woman, so props to her. She was a professor at UC Berkeley, its business school, Haas. She was chosen to be the vice chairman in 2010. Wall Street considers her to be a dove, one who is more concerned with unemployment than inflation. And she is the first woman to be chairman or chairwoman. So now let's talk about the Federal Reserve districts that split the United States into its respective districts. So as I said, there are 12 districts. And each district has its own district or head bank. So for District 1, the head bank is Boston. District 2, it's New York. District 3 is Philadelphia. District 4 is Cleveland, and so on. We are in District 2. It's an important thing to note that New Jersey is actually split between District 2 and 3. That's actually the case for a lot of states. So just something cool to point out. And if you're ever wondering about which district bank we report to the New York District Bank. But if you go more south into New Jersey, they might end up reporting to the District 3 Bank. So the goals of the Federal Reserve are price stability / inflation control, full employment output, and GDP growth. And when you study a little bit more about economics and how it was applied in the United States, you'll see that the Federal Reserve has had trouble enforcing these three goals. But at the end of the day, they have met some level of success for each single goal. Now, this doesn't mean that the Federal Reserve wasn't successful. It's just that that economics is such an unpredictable thing, and you don't know how it will play out. For an oil embargo, for example, you don't know how low the oil prices are going to go. I mean, how high the oil prices are going to go, because there's also politics involved. And as we all know, it's very hard to predict politics. You don't know. You don't know what will happen and when it will happen. It's also important to mention that a lot of these events are also volatile. And the Federal Reserve does its best to basically counteract the negative economic side effects that will result. So the job of the Federal Reserve, it has several responsibilities. It processes payments through its system, both check and electronic. Going to the Fed is so much more secure due to its regulation and its reliability. So a lot of the regulations include, the Dodd-Frank Act, Glass-Steagall Act, and so on. But the reliability comes from its age and the fact that it has a multitude of banks around the country. So almost every commercial bank is part of the Federal Reserve, and that's due to its many benefits. And you're always assured that when you put in your money, you'll always have it wherever you go. And that's just something that when you're part of the Fed's commercial bank, you will have. So the Federal Reserve also sets limits on how much cash the bank should have on hand to cover their deposits. The Federal Reserve is responsible for putting coins and currency into the system. It's responsible for removing worn bills and destroying them. It also establishes the amount of money commercial banks can lend on a certain day. And Bullet 2 and Bullet 5 will be a little bit more elaborated in a chapter presentation when we talk about the money supply and how it works with commercial banks. But essentially, the Federal Reserve decides that, and it's a job of the commercial banks to have money to lend, and that extra money is called excess reserves. And if they don't have enough money, they can get money from other banks. But I'll elaborate more on that later in this presentation. So I do want to talk about the Federal Open Market Committee. The committee meets regularly. The FOMC is composed of several entities. The Board of Governors, the New York Bank President, the New York Fed Bank President, and 4 regional bank presidents rotated in and out. So let's go back to this diagram. So for the FOMC, it's the Board of Governors, the New York Bank President, so District 2 is out. That leaves 11 districts. And Four of these districts are chosen. The president would then be part of the FOMC. Four of them. So let's say District 4, 7, 8, 12. So these four would be in the FOMC, serve their term, and then they rotate out, and four more would be picked. So suppose 9, 10, 11, 6. And now they'd serve their time in the FOMC, and they'd switch out, and four more would be picked. So the New York Fed makes the open market operations that influence the money supply. So that's why they're always on the FOMC. They need to have a say since all the actions would be done by them. So what that means is any open market operation would be done by the New York Fed, not the Philadelphia president of the Fed. So basically, for example, an open market operation would be buying bonds. So the New York Fed would buy the bond, not District 11 with Dallas as president, with the Dallas Fed. So what does the Fed do? So what does the Fed do? It can buy and sell bonds, such as government bonds. It also establishes the Fed funds rate. It's a rate that commercial banks charge each other for overnight loans of excess reserves. So this is basically done to help other banks meet the required reserves. I know this might sound a little bit foreign to you, but as you study the AP Macroeconomics, you learn more about this, and you find that the Fed funds rate is actually a very helpful way. But to give a quick explanation, the required reserves is basically the limit that the Fed establishes on commercial banks. That's the money that they can have. And the excess reserves are basically the extra money that they have that they can loan out. So basically, the Fed funds rate is helpful because if the commercial banks are below the reserve rate, the required reserves, they can be in a lot of trouble. So they can loan money. They can get money from other banks. Those other banks will loan it on a Fed funds rate. So they loan the money and then get some back when the bank that needs the money is done with it. So the discount rate is basically the rate that the Fed charges banks that come to them for a loan. So basically, the Fed funds rate is when commercial bank X needs money and they go to commercial bank Z. The discount rate comes into play when commercial bank X asks the Fed rather than another commercial bank. And because of that, the rate is normally 0.5 to 1% higher than the Fed funds rate. So why do we need the Fed? As I've said before, it helps stabilize the money supply with its open market operations and other techniques, buying, selling government bonds, adjusting the Fed funds rate, etc. It can also help counteract disastrous economic side effects from tumultuous political events. So let's take the oil embargo, for example, in the 1970s area. So when that happened, the Federal Reserve, it basically shot oil prices up. Inflation was skyrocketing, and that triggered a recession. And the Fed decided to increase its Fed funds rate to counteract the inflation, so that the inflation would go down, and things would eventually go down to normal. And they also had help from the federal government to help the people. Another political event is Brexit, and it had terrible economic side effects. Country's GDP were falling. The stock market took a dive, and we'll see how the Fed decides to counteract the economic side effects of Brexit. So the Fed also assists in the inflation scenario. So what that means is with the adjusting of the Fed funds rate, the discount rate, or with its open market operations, it can change inflation. It can increase inflation when inflation is too low, or curb inflation when inflation is too high. And we always want to have a moderate amount of inflation so that we promote a steady growth of the country. Thank you for watching. My name is Vinay Gonagonla, and I look forward to teaching the next presentation with you guys.